Okay, so the fact is, we talk about money, and a lot of people just think about the banknotes, and that's a mistake, because the system that we live in is much more complicated. Most of the transactions we engage in, be they really large or small, are in bank liabilities. Okay, so the money supply, as we define it, is this cash in the hands of the public plus liabilities of commercial banks, not the central bank, but the commercial banks. And the commercial banks get those liabilities by making loans. In other words, the liabilities of the commercial banks are matched by lending activity of those same banks. And in the aggregate, when you add up all the liabilities and assets and put them into a balance sheet, a consolidated balance sheet, you see loans and securities on the left-hand side, and you see deposits of individuals on the right. Deposits of individuals means households and firms that literally have a claim on the bank. They have a bank deposit, they have a savings account, they have some other type of loan that they've engaged in to the bank. They're the savers. Okay, and the lending activity of banks in the aggregate can be much, much larger than the amount of cash that the economy has in the system. So it's important to understand that the central bank is only part of the story, directly, so to speak. And the way the banks inject these liabilities into the system is through their lending activity. So you can imagine, if you go to a bank and you buy a car, the bank is literally selling a contract to you where you get a large amount of money now and you have to pay it back in the future. And that contract involves you getting immediately a big chunk of money on your bank account. You don't go to a bank to buy a car and get 50,000 euros in cash and take it to the auto dealer. No, you get 50,000 credit in a bank account, which the bank has created just for the purposes of making this loan. So the bank literally has created money out of thin air. And that's really hard for us to understand, but that's the way banks work. Banks would not do that unless they could be sure that in the future they will have enough cash on hand to pay demands of people coming in who want to close their account, or people who want to suddenly withdraw their money for some emergency. And the banks have got this down, especially larger banks. Smaller banks might have difficulties. But that act, that is this divorcing of the act of savings and the act of spending is kind of an important aspect of what banks do. And it's certainly true that if I bring money to the bank that I had under my pillow and put it in the bank, that creates possible lending opportunities for the bank. But the bank doesn't have to have my money from the pillow to make its loan. So it's important to understand that banks are much less mechanical. Now, if banks have reserve requirements and have lent all they can, then indeed me coming with my money from under my pillow, under my mattress, would indeed allow the bank to push out their lending activity a bit more. But that's the exception, especially now after the financial crisis. A lot of banks hold excess reserves. So they've parked a lot of liquidity at the central bank and may even be paying interest for the privilege of doing so, maybe in the expectation of lending in the future.